Here's something wild. If you had invested $10,000 in a stock like Amazon in the late 90s and held on to it, you'd be sitting on millions today. But here's the catch. Most investors didn't. Why? They either sold too soon or didn't spot its potential to begin with. Philip Fisher's book, Common Stocks and Uncommon Profits, teaches us how to find those game-changing investments, and more importantly, how to stick with them. Welcome to Financial Library. Investing is hard, but it doesn't have to be confusing. Today, we're exploring Philip Fisher's legendary book, which revolutionized how people evaluate investments. Fisher focused on finding long-term winners instead of short-term gains. Whether you're new to investing or a seasoned pro, his timeless lessons will make you rethink your strategy. Let's be real. Most people approach investing the wrong way. They're glued to stock tickers, chasing the next hot pick, or obsessing over market news. It's exhausting, and more often than not, ineffective. One of the biggest problems is the focus on price instead of value. People treat stocks like lottery tickets, forgetting they're buying part ownership in a company. And then there's the noise. Analysts shouting conflicting advice, Reddit threads pumping speculative stocks, and financial influencers promising overnight riches. This information overload makes it hard to stick to a clear, logical strategy. Fisher's work cuts through all this clutter. He didn't just look at numbers or trends. He studied companies like a private investigator. His approach? Ignore the market's mood swings and focus on the fundamentals. The goal isn't to find the next stock that spikes. It's to find businesses that can grow steadily for years, even decades. Let's break down Fisher's core principles in more detail and expand on how you can apply them today. 1. Understand management like a detective. Strong leadership is the lifeblood of any successful company. Think of great CEOs like Elon Musk or Satya Nadella, leaders who innovate, inspire, and execute consistently. Fisher stressed that understanding management's quality is just as important as analyzing financial metrics. So, how do you evaluate leadership? Here's a checklist. Track record. Has the leadership steered the company successfully through challenges? Communication style. Do they communicate honestly with investors, especially during tough times? A CEO who dodges questions or sugarcoats issues is a red flag. Vision. Does the leadership have a long-term growth strategy, or are they focused on short-term results to please Wall Street? Take the example of Apple. Under Tim Cook's leadership, the company shifted its focus to services, diversifying its revenue beyond hardware. This strategic pivot has significantly boosted Apple's valuation over time, proving the importance of visionary leadership. 2. The Scuttlebutt Method. This might be Fisher's most practical and underused advice. The Scuttlebutt Method is all about gathering real-world intelligence on a company. Financial reports are important, but they don't tell the whole story. Here's how you can use the Scuttlebutt Method in today's world. Online reviews. Check customer reviews on platforms like Amazon or Trustpilot. Are people raving about the product, or are complaints piling up? Glassdoor. Look at employee feedback. A company with high ratings from its staff likely has a positive work culture, which translates to better performance. Industry experts. Follow discussions on LinkedIn or industry forums. Professionals in the field often share insights about key players and market trends. Let's say you're researching a company that makes electric vehicles. Beyond the financials, you'd want to know, are the customers satisfied with the product? Are suppliers confident in the company's reliability? Are competitors worried about this company disrupting the market? These are the questions that uncover hidden opportunities. 3. Focus on growth potential. Growth isn't just about numbers on a chart. It's about whether a company is positioned to dominate its market. Fisher believed in finding businesses with exponential potential, even if they weren't the biggest players yet. Here's how to assess growth potential. Industry trends. Is the company operating in a growing market? Think of industries like renewable energy or artificial intelligence. Innovation. Does the company invest in research and development? Fisher loved businesses that stayed ahead of the curve with cutting-edge products or services. Scalability. Can the company easily expand operations without massive costs? A modern example is Shopify. Years ago, it was just another e-commerce platform. But its focus on empowering small businesses, constant innovation, and scalability has turned it into a global powerhouse. Investors who spotted this potential early have seen massive returns. Quick pause. If you're learning something new here, hit subscribe. I do my best to make my videos useful and actionable for you. Now back to the video. 4. Avoid over-diversification. Fisher's take on diversification goes against what most financial advisors preach. While diversification reduces risk, overdoing it waters down your returns. Fisher recommended concentrating your investments in a handful of great companies instead of spreading yourself too thin. Here's why. Focus equals mastery. When you own too many stocks, it's impossible to stay informed about each company. A concentrated portfolio lets you truly understand your investments. Quality over quantity. It's better to own 10 outstanding businesses than 30 mediocre ones. Let's illustrate this with Warren Buffett, a Fisher devotee. Buffett's Berkshire Hathaway famously concentrates its investments in a few big winners like Apple, Coca-Cola, and American Express. This focused approach has consistently delivered market-beating returns. If you're worried about risk, remember this. The key is not to avoid risk altogether, but to manage it wisely by choosing companies with strong fundamentals and holding them long-term. 5. Patience is a superpower. Here's a truth few people talk about. Successful investing often feels boring. Fisher's philosophy teaches us that once you've found a great company, the best thing you can do is wait. Consider this. In the early days of Amazon, many investors bailed after the dot-com crash, thinking the company was done for. But those who held on, those who trusted the business model and leadership, saw Amazon become a trillion-dollar empire. The lesson? Trust your research and don't let short-term volatility shake you. Investing isn't about timing the market. It's about time in the market. The biggest takeaway from Fisher's philosophy is the mindset shift. Stop thinking of stocks as abstract symbols on a screen. Think of them as pieces of real businesses run by real people. This perspective changes everything. Suddenly, you're not reacting to every price fluctuation or news headline. You're analyzing companies like an owner, asking, is this business solving real problems? Does it have a competitive edge that others can't easily replicate? Will it still be relevant 10 years from now? Once you start thinking like this, investing becomes less stressful and far more rewarding. So here's the deal. Fisher's approach boils down to 3 things: researching management, understanding a company's growth potential, and being patient. These principles might sound simple, but they require discipline and a willingness to think differently from the crowd. What do you think about Fisher's strategies? Have you applied any of them in your investing journey? Let me know in the comments. And check out this video about one of the best financial books ever written. It's packed with actionable tips you can use right away. See you in my next video. Bye!